Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. I hope that you all have a great and restful long weekend. Very good morning. Today will be Tuesday, the 1st of April 2025, and welcome to a brand new week as well as a brand new month for the start of this week. So before we start our gist of today's Daily Dose, we have very much interesting ground to cover. Let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Oops, I hope that the screen is moving. All right, any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into today's intraday technical outlook on those broad-based cross-asset classes that we cover on a daily basis, the major stock indices spanning from Hong Kong, Japan, US, and Europe, which is Germany, and as well as the major US dollar pair, followed by the two key commodities, gold XAU/USD and West Texas crude oil. Let's have a recap in terms of the performance of these major cross-asset classes in relation to the release of the recent economic data on last Friday, and as well as any event that is upcoming as well, which I covered towards the end and in today's early Asia session. So we know that last week we do mention that whatever correct bounce on the major US stock indices is more corrective in nature, dead cat bounce. So indeed, we start to see a very broad-based weakness across the board on last Friday, where the US market, stock market sold off right exactly at our pivotal resistance that we highlighted on the Nasdaq 100, and as well as the US Wall Street 30, representing the Dow Jones Industrial Average. So what we could see on the reaction on after last Friday's sell-off. So last Friday's sell-off reaction on the US stock market was actually pretty much driven by this higher than expected core PCE price index, as you see on my screen over here. So we know that core PCE price index, why is important? Because this is the key inflation gauge that the US Fed monitor. So it came in at slightly higher at 2.8% year on year for February. Markets expecting initially was 2.7%. All right, and also the consumer sentiment data, the final one, actually it came in much more slightly worsened than the preliminary figure that was released 2 weeks ago. So the final figure for Michigan consumer sentiment dropped further to 57, and previously it was 57.9, if I'm not wrong. Yeah, previously the preliminary reading was 57.9 and it dropped to 57. So this is actually the third straight month of decline in University of Michigan consumer sentiment, and it hit the lowest level since November 22. So you look at the 10-year trend, it very clearly is in the kind of a downtrend, and it break up a series of higher low previously printed in July 2022. So very clearly that right now we are in a broad-based, at least a medium-term downtrend for the University of Michigan consumer sentiment. So we know that US economy is driven by services activity, and the bulk of services activity leading economic indicator about consumer confidence. So that actually kickstart a bearish leg on the major US stock indices on last Friday. So we know that price index of highly liquid instrument like the major US stock indices, they don't move vertical up and down, they oscillate within trends. So what you could see over here is that after last Friday dramatic sell-off in the major US stock indices, coupled with the sell-off that was seen in yesterday's Asia session as well, that causes the major US stock indices to be in deeply oversold on the hourly time frame. So that actually explains to us why all the major US stock indices managed to stage recovery yesterday. So this was the S&P 500. First 30 minutes there was a sell-off. After the sell-off, it actually rallied all the way up to close near the high at 0.55 at 5,611, which is managed to see a end of the US session gain of 0.5%, Very similar on the Nasdaq 100 as well, which managed to actually erase its losses almost unchanged, negative 0.02%. So first half an hour sell off. After the sell off, there was actually a sharp rally throughout the entire US session yesterday. So the best performer was still the Dow Jones Industrial Average, which is up by 1%. All right, yesterday. Okay, oops, sorry, where is it? Pardon me, let me open my screen again. Okay, let me rest. Let show for a while because I usually, yeah. So this is the Dow Jones Industrial Average. Sell off half an hour, then rally all the way up to end the session at 1% yesterday. All right. So overall, what we could see over here is that, but however, the Russell 2000 actually underperformed with a loss of negative 0.56%. So that doesn't really gel well to the market breadth if you look at the intermarket performance of the major US stock indices. So the Russell 2000 comprises of small cap companies in the US stock market, which is very highly directly correlated, means their revenues are highly directly correlated to the health of the US economy. So if the Russell 2000 doesn't participate in yesterday's rally that's led by the Dow Jones Industrial Average, that actually also represent weakness in the major US stock indices as well. So later I'll share with you when I cover the intermarket segment. Yesterday rally in the major US stock indices, that means the S&P 500, the Dow Jones and the Nasdaq 100, is more likely to be short-term corrective rebound, i.e. dead cat bounce. That means i.e. we have not started to see a meaningful medium-term, we call it a bullish reversal yet on the major US stock indices, despite yesterday's intraday up move on the S&P, the Nasdaq, and the Dow Jones. I'll explain to you all why. All right. So then what we could see over here is in the FX market, we start to see dollar strength selling off as we're speaking right now. That means, i.e., the dollar is getting weak against the Kiwi and the Aussie, and as well as the dollar CAD start to trade sideways. But it starts to actually underperform against the dollar yen, the euro, and somehow against the sterling dollar as well. Right. So because you see over here is that why the dollar starts to actually underperform is actually primarily due to the US 10-year Treasury yield. So the US 10-year Treasury yield has failed to actually do a meaningful breakout above the 20-day moving average, got rejected at the 50-day moving average, acting as a resistance at 4.4% level over here. So what we could see at this point in time is that the US 10-year Treasury yield may start to see further downside as it starts to actually breach below the 200-day moving average, but managed to survive at the key 4.16% level. So a further breakdown below this 4.16 medium-term pivotal support level on the US 10-year Treasury yield will represent a further weakness on the longer term US interest rate, likely driven by a weaker economic growth prospect in the US economy. So that could start to see the 10-year Treasury yield showing further weakness, perhaps back towards the 3.6% level. So if you look at the shorter term 2-year Treasury yield as well, this has been clearly broken down below the 200-day moving average. So it's the 2-year Treasury yield showing further potential weakness heading towards the 3.55% level. So with further weakness in the US Treasury yield, both from potentially both from the 10-year and the 2-year, that could reduce what I call the US Treasury yield premium against the rest of the world. So that should explain to us why we are seeing this ongoing short-term dollar weakness as we are speaking right now. So this is a 5-day rolling performance of the US dollar against other major currency as we are speaking. All right. So for today's Asia session, what we could see is that we have the release of this Caixin manufacturing PMI data, which is also is actually a slightly different MPI data, the manufacturing PMI data that was released yesterday. Because yesterday we do have they call it the MBS manufacturing PMI data. So what's this difference between MBS and Caixin manufacturing PMI data of China? Is the MBS manufacturing PMI data is compiled by the Statistical Board of China. That means it's a kind of a state-owned official manufacturing PMI that comprises of more larger manufacturers. Whereas the Caixin manufacturing PMI is compiled by Caixin, which is a private organization, the news, the one of the leading we call it a news organization in China that comprises both the large manufacturer and as well as the SME. So some market participants will view the Caixin manufacturing PMI as a better gauge of manufacturing activities in China because it comprises of the SME as well. So, but let me touch on the non-manufacturing PMI data that was released yesterday, and as well as the non-manufacturing manufacturing the official manufacturing PMI data, and as well as the official non-manufacturing PMI data, which is the services PMI. So the NBS manufacturing PMI, official manufacturing PMI data came in expectation. Market is expecting at 50.5. It came in at 50.5 exactly, slightly above 50.2. And from the previous month of February, and the non-manufacturing official PMI also came in better than expected, 50.5. Consensus was 50.5, came in slightly better than expected, 50.8, and above 50.4. All right, and today the Caixin manufacturing PMI that comprises of the SME corporation in China came in also better than expected slightly. Market is expecting 50.1, it came in at 51.2, but it has a better gap above the previous month of 50.8. So if you look at the official number, the non-official Caixin manufacturing PMI, which comprises more of the SME, so if you look at the trend over here, okay, give me a minute for it to actually call out the data or call out the chart, I would say. So if you look at the trend, it actually increased it was the highest reading since November last year. So if you look at the 3-year trend, right, it's slowly inching up higher and printing a series of higher lower, so indicating that the current stimulus measure, or I would say that the guidance of much more physical stimulus that is coming in this year by China top policymakers has started to seep into the manufacturing PMI data on the as measured by, as compiled by Caixin. So that actually potentially sees that there's some form of business sentiment has started to improve in China, because bear in mind, manufacturing PMI data on all over the world is survey based, so it actually gauge the business sentiment of what they are going to do in the next couple of months, according to the various industry that the various organization poll to the businesses in China. All right, so because of this positive uptick in the Caixin manufacturing PMI data, we start to see the Hang Seng indices rally today after yesterday fall. So the Hang Seng indices is up by the Hang Seng index is up by 1.10%. The higher beta Hang Seng Tech is up by 1.61%. And the HSCEI, which comprises the H shares, the China H shares listed on the Hong Kong Stock Exchange, is up by 1%. All right, so about average 1.5%, 1% to 1.5%. So net overall, most of us is asking whether can the Hang Seng indices continue its 3 months of medium-term uptrend that has taken shape since the start of this year, or will there be more short-term weakness that initially we have really expected late last week, where we have a bearish bias to it. Later I'll cover up more in our intraday technical outlook on the Hang Seng indices represented by the Hong Kong 33. All right, so and on top of this, while we are speaking, there's actually this retail sales figure for Australia that was released earlier this morning over here. Okay, Australia retail sales. So the retail sales came in slightly below expectation. Markets, that's for the month of February. Markets expecting 0.3%. It came in at 0.2%. Then bear in mind that is actually before 12:30 p.m. RBA interest rate decision. All right, which is a pretty much key event. Later I'll touch on more today. So the Aussie dollar actually continues to actually slide from last Friday. Last Friday we have a neutrality level. It broke below that 62.50 mark over here, and it's like further during Monday session. All right, so later I'll touch more about the Aussie dollar. So I could see over here is that the Aussie dollar also, the Aussie the Aussie dollar now starts to actually kind of a previously there was this dollar strength getting prevalent. Then after the dollar strength starts to actually ease off over here against the Aussie dollar. So later I'll touch more on the intraday technical outlook. What are the key levels to watch out for today? All right, based on the technical perspective or the Aussie dollar on a very short term basis. All right. So now let me come to the second segment over here. So the second segment will be the intermarket dynamics. So I will cover more about the intermarket dynamics on the US stock market, given that yesterday's bounce on the US stock market, most of us are actually questioning whether this is the start of a potential medium-term bullish reversal, or will there be more weakness going forward? Why? Because this week is a key event week for the US, for the global economy, not even the US stock market, because we are approaching this called 2nd of April, Liberation Day, as proclaimed by US President Trump, of where he going to announce this broad-based reciprocal tariffs that is targeted on major trading, all trading partners with the US. All right. So far, we do not know what will be the percentage for each country. All right. So the quite Liberation Day, and market reacted accordingly very negative to yesterday. Then suddenly it turns positive again, because we know that the way Trump does policy is that he may change his mind during the last minute. But from that, let's take a look at the intermarket dynamics of against this policy noise, or what is the price action is telling us in the US stock market. So what we're going to do over here is that I'll touch on more about market breadth. All right, so we know that from intermarket perspective and technical, market breadth consists of what made up the health of the US stock market. So for example, market breadth, we could look at percentage of component stocks holding above their 20-day moving average, their 50-day moving average, and their 200-day moving average. So this one I really touched on last week over here, which indicate to us that the market breadth based on component stocks holding above key moving average, both the Nasdaq 100 and the S&P 500 continues to remain weak. So if you look at the percentage of Nasdaq stock above the 50-day moving average, it continues to be below 50%. As of yesterday's close, is at 32%, and the percentage of Nasdaq 100 stocks above the key 200-day moving average continues to thunder downwards. Now it's at 40%. Similar for the S&P, percentage of S&P 500 component stocks above the 50-day moving average is also below 50%, now at 39% as of yesterday's US session close, and the percentage of S&P 500 stocks above the 200-day moving average is also below 50% at 43%. So net overall, what we could see over here is a continuation of weakness in market breadth, as expressed by the percentage of component stocks of the Nasdaq 100 and the S&P 500 holding above the 50-day and the 200-day key moving averages. So another potential, another way of looking at market breadth is looking at sector performance, all right, of the S&P 500. So what I could see over here is that this sector performance, at the bottom, okay, at the top of my chart is the weekly chart of the S&P 500. So we know that the S&P 500 has really clearly closed below the 200-day moving average for 3 consecutive weeks. Okay, bear in mind this is trading view. So what we do over here is that this is a weekly time frame chart. That means every candle is a weekly candle. But however, I could overlay different time frame indicator by tweaking according to the parameter. So this moving average you see is a 200-day moving average, not a 200-week moving average. So I could see over here is that for the consecutive 1, 2, 3, and now it's the 4th week, it has been trading below the 200-day moving average after a retest of it last week. Right, so this is a very bearish reaction, a bearish retest of it, forming a bearish candlestick. And what we could see, this is a price action. Then underneath the market breadth, after this bearish retest, we got to see how the market breadth is telling us whether it's weak or whether it's strong, whether it's recovering. So by looking at the market breadth of the percentage of stocks holding above the 200-day moving average and the 50-day moving average is declining. And now I'm bringing another layer of market breadth analysis. I call it part of intermarket analysis or intermarket dynamics, is looking at sector performance of the S&P 500. So we know that S&P 500, there are 11 sectors in it. So what I'm going to do now is I'm taking the sector of consumer discretionary versus consumer staples. Okay, so what these two sectors means that consumer discretionary sector implies that if the consumer discretionary sector keep on going up, it should be supported by a healthy US economy. And consumer staples are we call it products like food. Example, we call it defensive. That means regardless of the cyclical movement of the US economy, US consumer will buy this product. Okay, it's like necessity. So what I'm going to do over here is that the top of this chart over here is that consumer discretionary equal weight. Okay, these are ETFs compiled by Invesco, which is the ETF, is one of the major ETF manager in the US. So this equal weight consumer discretionary versus equal weight consumer staples. Okay, why equal weight is important? You know that consumers discretionary is being sometimes skewed by one of the mega big cap stock, which is Amazon. Okay, so this is what I mean. So if we look at this heat map chart, you're able to see, you're able to understand what do I mean by this. Right, so this is consumer cyclical, or that's consumer discretionary. If you look at the box, all right, so this is a heat map of yesterday's performance of the S&P 500, all the S&P 500 component stocks. The bigger the box represent, the bigger the market cap, right? So all these box represent market cap, market capitalization of the individual stock. So you look at consumer cyclicals, which is consumer discretionary, over here in this big box, big area here, the biggest two weightage is Amazon and Tesla. All right, so what this particular ETF manager did over here is that they make every component stock in the consumer discretionary sector equal weight. That means Tesla is having a similar weight as the rest of the other consumer discretionary stocks inside the sector. All right, so if you look at the equal weight one, right now the market, the ratio between consumer discretionary divided by consumer staples now is actually testing a key parallel major support level that is in place since December 2022. If I look at the one that is market cap one, it's very similar as well. It's also testing this major key parallel support level, this ratio. So what it means that this ratio is slowly inching downwards, both the equal weight and the market cap weight. That means it's telling us that the consumer discretionary stocks in the S&P 500 is underperforming against the consumer staples. That means, i.e., a weakening market breadth. That means markets are not confident in building up consumer discretionary stocks. Why? Because of weakness in key economic data, like consumer sentiment is one of them, and we start to see an increase in inflation as well, which is PCE data. That means, i.e., the Fed will be less reluctant to introduce much more dovish guidance this year. So what we could see over here is that previously the breakdown of this ratio, right, in December 2021 have led to this multi-month corrective decline on the S&P 500 previously over here, both the equal weight and the market cap. Okay, we could see. So if this parallel descending trend line starts to break down by the end of this week again, that means very likely we will start to see multi-month corrective decline on the S&P 500, very similar that take shape over here previously from January 2022 all the way up to September 2022. So when i.e. That actually tells us that the probability of seeing a medium-term bullish reversal at this juncture on the major US stock indices is slim, given the very weak market breadth that we are seeing right now. Right, so that sum up the intermarket dynamics sense or intermarket analysis segment for today's daily dose of market insights. So with that, now let us now jump straight into the intraday technical outlook on the broad-based cross asset classes that I want to share with you guys on a daily basis, starting with the FX market. So as usual, let me expand my screen so that you guys have a better view of the charts. So let's start with the FX market first. All right, so let's start with the euro dollar. So the euro dollar on last Friday, we do have a bullish bias. We flipped to a bullish bias after the price action hit the 200-day moving average. Price indeed moved up as expected, almost hit our first support level at 1.0860 before inching downwards in yesterday's Asia session and throughout the middle part of the US session before staging a bounce. So what we're going to do now is we will tighten the short-term pivotal support level to last Friday European session low, which is the V-shaped recovery. Intraday V-shaped recovery you could see over here at 1.0765. So we have a tightened key short-term pivotal support at 1.0765 on the euro dollar, and we maintain the intraday bullish bias with first resistance coming in at 1.0860. A breakout above 1.0860 may expose 1.0910 next on the intraday basis for today. However, if price action starts to slide and break down the hourly close below 1.0765, today's intraday bullish bias will be negated to see a retest at the 200-day moving average at 1.0730. Only a breakdown below 1.0730 will trigger off the start of a newly corrective decline sequence on the intraday basis for the euro dollar to expose the next near-term support level at 1.0680 slash 1.0660. All right, so i.e. in a nutshell, we will have a tightened key short-term pivotal support for today on the euro dollar 1.0765 to maintain its intraday bullish bias. Up next will be the sterling dollar. So the sterling dollar managed to bounce on last Friday and hit our resistance level at 1.2980. All right, 1.2980 before trading sideways, and yesterday it did a pushback, a pull down, and this push down managed to survive at the lower limit of this medium term ascending channel that I drew from the low of 11th of February. All right, so for today we will have a first support level to watch will be the lower boundary of this medium term ascending channel. I think at the first support at 1.2910, but I don't want to target it so tightly, so I'll use the V-shaped recovery on last Thursday at 1.2870. So 1.2870 will be my short-term pivotal support for today, adjusted one on the sterling dollar, still maintaining that intraday bullish bias. First support level for sure will be last Friday resistance that got rejected at 1.2980. A breakout above 1.2980 exposes the next near-term resistance zone of 1.3025 slash 1.3040 next. All right, which is the minor swing high area of 30th of October and 6th of November last year. However, a price action breakdown below 1.2870 with an hourly close below it will negate today's bullish tone to see a retest at the 200-day moving average again at 1.2810. Only a breakdown below 1.2810 may trigger off a minor corrective decline sequence to expose 1.2715, which corresponds to the rising 50-day moving average as well. So i.e. in a nutshell, still maintaining a intraday bullish bias on the sterling dollar with a adjusted short-term pivotal support for today at 1.2870. Up next will be the Aussie dollar. So the Aussie dollar that I mentioned last Friday, we do have a neutrality stance. So this neutrality stance actually broke down below 1280 level. It came down, hit the next support level at 6240 before staging a bounce today. So we know that today's will be RBA as well. So potentially there could be a further potential bounce going forward. So this level to watch, the first resistance level to watch will be potentially this level here. Okay, this previous minor swing low turns into a minor swing low of 31st of March, breakdown down turns to a pullback resistance level at 6270. But given that today is the RBA day, I don't want to use this as my short-term pivotal resistance. I'll put it slightly higher, which is this minor trendline support level, ascending trendline support. Now turns into a minor pullback resistance, also close to the 50-day moving average as well, that was taken down on yesterday's European session. We tested it and come break out and inch down lower. All right, so 62.90 will be my short-term pivotal resistance for today on the Aussie dollar. We will flip to a intraday bearish bias on the Aussie dollar. First support level to watch 62.40. A breakdown below it may expose 61.90 next, which is the minor swing low of 28th of February and 4th of March. Only a hourly close and a breakup above 62.90 will invalidate today's intraday bearish bias to see a choppy upward drift to retest 63.25 and even 63.60 next on the Aussie dollar. So i.e. in a nutshell for today, first resistance level to watch as we head into RBA decision thereafter 12:30 p.m. 62.70. 62.90 will be my short-term pivotal resistance level, and we'll flip to a intraday bearish bias for today on the Aussie dollar. Okay, lastly will be the dollar yen. So the dollar yen plummeted as expected, hit our first support level at 148.90, which is a 20-day moving average before staging a bounce. And right now we do have a bearish reaction right exactly of this minor ascending trend line, now turns into a pullback resistance. And also the RSI continues to bank off a parallel resistance level as well, and now it's drifting back down towards below the 50 level, indicating resurgence of bearish momentum. And what we see is that yesterday's bounce actually bounced off exactly at the golden ratio of 61.8%. So with that, I'll be using 50.40 short-term pivotal resistance level, which is the pullback line the minor pullback resistance line of this former ascending trend line support from the low of 11 March. 150.40, as long as 150.40 short-term pivotal resistance is not surpassed to the upside, we will have maintained the intraday bearish bias on the dollar yen. First support level to watch was here 148.90. Only breakdown below 148.90 exposes 148.20, which is the minor swing low of 17th of March and 20th of March. However, a breakout and an hourly close above 150.40 will invalidate today's intraday bearish bias to see a squeeze up to revisit 151.30 in first step. Above it may expose 151.80 next, which is the close to the 50-day and the 200-day moving average, I think confluencing at a similar resistance zone as well at 151.30 and 151.80. So i.e. in a nutshell, using an adjusted short-term pivotal resistance for today, 150.40 on the dollar yen to maintain its intraday bearish bias for today. That sum up the intraday technical outlook on the major dollar pair. Up next, we'll cover the major the major stock indices, starting with the Hong Kong 33 over here. So the Hong Kong 33 came down, hit our first support level, and now staging a bounce back up again. So this first support level was highlighted on last Friday as well, 22,980, now staging a bounce over here. So now I will use a slightly tightened short-term pivotal resistance for today, 23,570 as my short-term pivotal resistance level, which is so the former minor swing low of last Thursday as well, that managed to shape a bounce. Then thereafter it break down, it shaped that last push down. All right, so as long as 23,570 holds for today on the tightened short-term pivotal resistance, we will have maintained the intraday bearish bias on this Hong Kong 33, represent the Hang Seng Index. First support level to watch will be the bounce that is taking shape on yesterday's US session at 20. Yeah, this was taken shape in yesterday US session, 22,980. Below 22,980, thereafter exposes 22,690 next. Only a breakup above 23,570 that would negate today's intraday bearish bias to see a drift up to retest the 20-day moving average. I think as the confluencing with the next resistance zone at 23,820 / 23,965. So i.e. using a tightened short-term pivotal resistance for today at 23,570 to maintain that intraday bearish bias on the Hong Kong 33, representing the Hang Seng Index. Up next will be the Japan 225. So the Japan 225 over here has starts to actually drift downwards over here from here. So what we could see over here is that the momentum indicator still remains weaker over here. So there's, as we are speaking, there was actually a rejection off at the 50 level mark, right at the 50 level mark over here. Okay, there's a rejection of it. So with that, we will still maintain. It actually came down, hit our support level, all right, at 37,220 / 4550 that we have on last Friday. So we're using this level here to be my short-term pivotal resistance. Okay, so this will be my short-term pivotal resistance level because of this weakness. Okay, and this level here will be my first support level to watch. Okay, so right now we have a tightened short-term pivotal resistance zone at 36,220 / 36,450, which is this former minor swing low area of 5th of March and 11th of March here, now turns into a pullback resistance. RSI, hourly RSI still remains weak, got rejected at the 50 level mark over here, indicating the resurgence of intraday bearish momentum on the hourly RSI. So we'll still maintain that intraday bearish bias on the Japan 225, representing the Nikkei 225 on the intraday basis, using a tightened short-term pivotal resistance for today, 36,220 / 450. First support level to watch will be yesterday's US session low at 35,540. A breakdown below 35,540 exposes 35,115 next. All right. However, a squeeze up above 36,450 will negate today's intraday bearish bias to see the start of another minor counter trend rebound scenario for the next intermediate resistance to come in at 36,650. Above 36,650 exposes 37,200 next, which correspond to the 20-day moving average, acting as a similar resistance level as well. okay, at 37,200 level. Okay, let me put it in writing. All right, 37,200 level. Okay, so still maintaining that intraday bearish bias on the Japan 225, representing the Nikkei 225 with a tightened short-term pivotal resistance level for today at 36,220/450 next. All right, so that's for the Japan 225. Up next will be the German 30, representing the German DAX over here. So the price action plummeted as expected over here, hit the support level 21,120 slash 21,050, which is the minor swing low of last Monday. Price action now also broken below the 50-day moving average, and as well as the gap down that was seen on previous Monday as well. Okay, a gap down that was seen on this Monday, which is yesterday. Yesterday's. All right. So using this 50-day moving average and the gap down that was seen yesterday, first resistance level 22,440, 22,500 level over here. Okay, let me put it in writing. Okay, 22,440 slash 510. All right, so this is the first resistance level to watch. All right, but I will not use this resistance zone here as my short-term pivotal resistance level. I'll use it slightly higher, which is the minor swing low area of 21st of March. Rejected on breakdown, rejected on the 27th of March. Before, after this rejection, it staged that last severe plunge down on an intraday basis last Friday. So this could be a key reaction level, 22,760. And if I do the Fibo retracement over here, okay, it also corresponds very closely to the golden ratio as well of 61.8%. All right, let me put it tightly. Yeah, 61.8%. So with that, using adjusted short-term pivotal resistance for today at 22,760, as well as any price bounce didn't surpass above 22,760, adjusted short-term pivotal resistance on the Germany 30 will still maintain that intraday bearish bias. A breakdown below 22,120/050 for today exposes the next near-term support level at 21,970 next. However, if a price action starts to have a breakup and a squeeze up above 22,760 short-term pivotal resistance level for today, today's intraday bearish bias will be negated to revisit or to expose the next near-term resistance level at 22,940, which correspond to the 220-day moving average, pardon me, acting as a similar resistance level as well. Above 22,940, we'll see a deeper corrective rebound sequence unfolding, revisiting the minor swing high area of 26th of March, acting as the next intermediate resistance at 23,230. So i.e. in a nutshell, still maintaining that intraday bearish bias on the German 30 using an adjusted short-term pivotal resistance for today at 22,760. Right. Up next will be the major US stock indices, starting with the US Wall Street 30 representing the Dow Jones Industrial Average. So the price action plummeted as expected, hit 41,200 before shaping that sharp bounce up. So that short bounce up got rejected exactly at the 20-day moving average, acting as the first resistance level at 42,055 level. So I will use a slightly higher level as my pivotal resistance level for today at 42,340, right, which also correspond to the upper the former lower boundary of this ascending range channel support now turns into a pullback resistance and also confluencing with the 200-day moving average as well. And if you do the Fibo retracement of the entire push down from last Wednesday all the way down to yesterday's US session intraday low, that also corresponds very closely to the golden ratio of 61.8%. So using an adjusted short-term pivotal resistance for today on the US Wall Street 30 at 42,340, 42,340 level, 42,340 level on the US Wall Street 30, will maintain that intraday bearish bias. Support level to watch will be 41,670, 41,450, followed by the key 41,200 level for today. Right. However, only a squeeze up and a breakup and hourly close above 42,340 short-term pivotal resistance will invalidate today's intraday bearish bias on the US Wall Street 30 to see a squeeze up towards 42,570. Above it may revisit 42,980/43,120 next, which is the congestion area of 4th of March and 6th of March over here. So i.e. in a nutshell, still maintaining that intraday bearish bias with an adjusted short-term pivotal resistance level at 42,340 on the US Wall Street 30. And so given that the hourly RSI has already started to inch downwards after hitting the overbought level at the end of yesterday's US session. Now, next up will be the Nasdaq 100. So the Nasdaq 100 plummeted as expected as well. So what we could see over here is that we will have a tightened short-term pivotal resistance level for today, which is the former minus swing high area of 18th of March, a former minus swing low area of 18th of March and 21st of March. 19,430/19,490 next. All right, so as long as this tightened short-term pivotal resistance level is not surpassed, 19,430/19,490, we'll still maintain that intraday bearish bias on the Nasdaq 100. First support level to watch will be 19,130, a breakdown below 19,130, which is currently today's intraday lows of Asia session. We'll revisit yesterday's start of US session low at 18,800 next. All right, however, hourly close and the breakout above 19,490 will invalidate today's intraday bearish bias to kickstart another minor mean reversion rebound sequence, exposing the next near-term support resistance level at 19,770, which corresponds to the 20-day moving average, acting as a similar resistance level as well, and close to this former minor ascending range channel support now turns into a pullback resistance, also acting as next resistance level at very close to the 19,770 level. All right, so in a nutshell, still maintaining that intraday bearish bias on the Nasdaq 100 with a tightened short-term pivotal resistance for today at 19,430/19,490. Okay, so that sum up the intraday technical outlook on the major stock indices. Let us turn our attention, our focus now to the commodities market, gold. So gold is one of the best performing assets so far this year, riding on the cocktails of stagflationary risk environment, which is potentially unfolding due to Trump's rather erratic and aggressive trade tariffs policy. So what we could see over here is that previously we do have a short-term resistance level. It has been made at 3,110 level. So now it's actually slowly inching upwards. Breakout above this minor ascending channel or medium-term ascending channel upper limit. Yesterday, this is a turquoise green, and now seems to be trading in a steeper ascending channel that I drew from the low of 11th of March. Hourly RSI is in the overbought level over here, but there's no clear bearish divergence. It's being seen on the hourly RSI, indicating that upside momentum remains intact, but there could be a chance of a minor pullback taking shape because it's at the overbought level right now. So first resistance level to watch out for will be this branch of minor swing high area that has been taken shape during the start of during the European session, and it got broken up at the start of today's Asia session. So from yesterday's European session all the way up to the US session is traded in a minor sideways range, and only in today's Asia session it got a bullish breakout. So this will be the first support level to watch out for today, 3,128. But I don't want to use this as a medium as my short-term pivotal support level. I'll use the minor swing low area of 31st of March, formerly the resistance, now turns into a key support level, 3,110. So as long as any minor dip didn't surpass below 3,110, we'll still maintain that intraday bullish bias on gold XAU/USD. First resistance level to watch 3,160, followed by 3,180 today, which is a Fibo extension cluster level. However, a breakdown with an hourly close below 3,110 will negate today's intraday bullish bias to see the start of a much more pronounced minor corrective dip or slide, exposing the next near-term support zone at 3,076, 3,090. Below it may see 3,060 next coming in, which is the former minor swing high area of 20th of March. 27th of March now turns into a pullback support, and as well as the lower limit of this steeper ascending channel from the low of 11th of March. So i.e. in a nutshell, using a slightly higher short-term pivotal support level for today, 3,110, to maintain our intraday bullish bias on gold XAU/USD. Lastly will be the West Texas crude oil. So West Texas crude oil, before we go for our Hari Raya break, we still have that bullish bias. So the bullish bias hit 71.45. So and it appears above the 50-day moving average. So right now it's doing an extension of this corrective rebound phase that is still intact. That has taken shape since the low of 6th of March, which is the earlier March, the start which is the start of the month of March, right? So potentially now it may start to mean revert back towards the 200-day moving average at 73.30. So with that, first support level to watch out for today will be the bullish breakout of this former minor ascending channel support, former minor ascending channel resistance. The upper limit now turns into a pullback support at 71.45, using the 50-day moving average as my short-term pivotal support level for today, which is also the minor swing high area of 28th of February and 3rd of March now turns into a pullback resistance and pullback support level as well at 70.80, which corresponds to the 50-day moving average. I think it's a similar support. So as long as any minor, as long as the pullback didn't surpass below Titan short-term pivotal support today at 70.80, we'll still maintain that intraday bullish bias for the extension of this mean reversion correcting rebound phase to play out on the West Texas oil. Next resistance level to watch on the intraday basis, 72.40, followed by the key 73.30 resistance level, which is also the minor swing high area of 20th of February and 31st of February, and confluencing with the key 200-day moving average. However, if price action starts to break down and the hourly close below 70.80 Titan short-term pivotal support level on West Texas oil, potentially this mean reversion corrective rebound from the low of 6th of March may have already ended or terminated and kickstart a rather bearish, we call it a corrective decline sequence, exposing the next near-term support in first step at 69.60, followed by 68.77 next. All right, so that's for West Texas crude oil, and that also sum up the intraday technical outlook on the major broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What other data to look out for other data or key event to look out for today other than RBA interest rate decision, which is at 12:30 p.m. Singapore time. So market, okay, the result are 4 point. Oops, let me. Oh, is the decision out? Okay, let me put it again now. Okay, this week. Okay. Oh, it seems to me that the decision is out at 4.1 percent is out earlier. It was previous was 12:30 p.m. Okay, so no change as what market is expecting. So now the focus will be at 2:30 p.m. So let me do a check. This should be Singapore time. Yeah, UTC +8 Singapore timing. So it will be at 2:30 p.m. Singapore time today, the press conference of RBA governor. So they'll be closely watched over here whether she still maintain that rather cautious tonality about sticky inflation coming into play. So that's 2:30 p.m. Singapore time. And from there onwards, we have a key European data, which is the Eurozone inflation flash data, the core inflation flash data. Market is expecting a slight dip to 2.5% year on year from the previous month of 2.6% in February. So that will be out at 5 p.m. Singapore time. And at 8:30 p.m. Singapore time will be ECB President Lagarde speech. So that will be closely watched. That could impact the euro dollar as well, and in some form the German DAX. And followed by 10 p.m. Singapore time, we have the ISM manufacturing PMI data. So market will be looking at the headline number where it get weaker. So previously was 50.3, market is expecting a contraction to 49.5. And also the closely watched ISM manufacturing prices input data, if it continues to inch higher, market is expecting 65 from 62.4. That also explains sticky inflation situation in the US economy that would potentially be detrimental to the major US stock indices as well, given that the Fed will be less likely to be rather having a dovish, much more pronounced, means the Fed may not be able to have a pronounced dovish stance in this year. Right, so that's 10 p.m. Singapore time. And thereafter will be a rather a quiet US session, but on top of that, do take note of the release of this 1st of April, which is today. So uh, joint agency from the Commerce Department, the Trade Department, and the Treasury Department of the US will release this trade and currency review report on China, Mexico, and Canada. So this report will be made public, and that potentially could impact the trade reciprocal trade tariffs that going to be announced officially on 2nd of April tomorrow. So something to be aware of as this trade review report is being made public today on Canada, Mexico and China. So that could be a market moving event as well. All right. So with that, that sum up today's daily dose of market insights. I'm Kelvin here. Wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.